Hello again and welcome to this instructional video on using our estimators. The one that we're going to look at today is the Landlords Section 24 estimators. If you're going to use this estimator, we strongly recommend that once you've used it, you print off the results, take it to your accountant and gain some independent financial advice, especially if your business is affected, as most landlords property businesses will be in the near future. So let's click on here, let's begin. So we're going to click on this link. Just waiting for our website to catch up. Okay, so the first thing is here is the write-up that we did. It's more of an introduction, and it basically says Section 24, we as landlords call it the tenant tax. And it says, landlords, do you remember this person? And there's a picture there of George Osborne, who's now editor of the London Evening Standard, but he was actually the Chancellor of the Exchequer. In 2015, he decided to abolish tax relief on buy-to-let mortgages, and from the 6th of April 2017, basically landlords are now going to be taxed on any interest that they pay to their bank at their any rate above the standard income tax rate, which is currently 20%. So if you're a higher rate taxpayer, the difference between 20% and whatever you're paying, you're going to end up paying tax on that. So at the time it was announced, which was in 2015, he said that only 1 in 5 landlords would be affected. Well, from our experience, this is just simply patent garbage. It's going to affect hundreds of thousands of landlords and probably millions of tenants. He's basically introduced a turnover tax on bank loan interest payments, but it only affects buy-to-let landlords. So if you're a furnished holiday let, a council, housing association, a charity, a limited company, or a big corporate provider, a lot of his friends, yeah, the politicians are still sticking obviously to their press office spin, and these groups won't be affected. But however, everyone else will be. When you look at the figures, when you do your calculations, in some instances it causes instant disbelief. So obviously somebody must be lying to us. So any buy-to-let landlord who's a combined gross salary or net profit plus your finance interest in excess of £45,000 is going to be badly affected. The example that is preset below is for a buy-to-let landlord with a portfolio of 23 properties but only earns the minimum living wage of £14,796 per year from his or her buy-to-let business. So despite the urban myths out there, there are thousands and thousands of buy-to-let landlords who actually don't make any money from their investment, basically just using the property as an additional future pension provision. And as it says here, they may well wish that they hadn't in the near future. So you'll notice here that there's a graph, and by the end, if you were earning £796, currently your tax bill would be that £658. But if you, this particular landlord that's we're doing an example of here, has around about 22 properties, and his tax bill or her tax bill is going to rocket to £29,461. Okay, so basically, will you go bust? Well, to see who's right and who's wrong, just enter your own figures in the estimator and see what happens to your tax position and your tenant's rent. The more money you've borrowed, the worse the changes will be. Once you have a figure, get it printed off and make an appointment to see your accountant and plan for your next tax bill. So here we go. So the first thing you need to input is, this is a calculator. We need to know the average property value for your portfolio. So if your portfolio is a portfolio of 1 and that house is worth 99,000, well, that's your average property. But if you've got a property portfolio and it's worth 17 million, okay, you've got to divide that 17 million by the number of properties that you've got. So let's assume that your average property value for you, to keep the figures simple, say is £100,000. So we'll put in £100,000 there, and then you just enter the number of buy-to-let properties that you've currently got. So in this instance, we'll leave this, say, at 20. No, we'll bring it down to 20. 20. You can input a figure here, or if you've got a smartphone that you're using at the moment, or an iPad or something like that, you can press these plus or minus buttons to change that total. Now the next thing is, hopefully this won't be too confusing, we need to know the average loan to value. So basically, if you tot up the value of all your buy-to-let properties and divide that then by the amount of money that you currently owe still to your banks or building societies or wherever you've got your finance from, you can work out your average loan to value. So at this instance, we'll say most landlords stick to around about 55 to 70%, but let's say it's 70%. Okay, and at the moment the interest rates are low, they're historically low. However, as you as a landlord are well aware, the banks and the building societies that you borrow from are asking you to stress test your business. And stress test means they want you to anticipate what would happen if interest rates rise. So let's just drop this to a smaller amount. Sorry, I'm getting messages here. Say it drops to 3 3/4%. And you're getting a warning here. Basically, you should stress test your business to 6%. Okay, but we'll leave it at that. So let's make it 4%. So it's gone to 4%. So on this calculation, you've got 20 properties, all averaging £100,000 in value, with an average loan to value of 70%. And let's assume that the interest rate is 4%. So how are you affected? Sorry, I'm changing the interest rate there. So the estimated yearly interest on each property is £2,800 that you're paying, and per property, sorry, for 20 properties it will be £56,000 over the year. Now the government are now going to make this a taxable amount for landlords, and basically if you earn the minimum living wage, which is around about 14,625, okay, the tax before the rule changes will be £625, and the tax after the rule changes will now go to £5,750. So for each one of your properties, you should charge your tenants an extra £256 per year per property. And if you want to know how much that is a month, it's £21.35, or if you're doing weekly rents, a weekly rate increase is £4.93 for all your lovely tenants. Okay, so let's see what happens now when the interest rates are stress tested, say to 6%. Okay. And now we'll assume that you've just got the minimum living wage in profit from your business. If it's more, if you've got an outside job, enter in there your gross salary plus any buy-to-let net profit. So at the moment we're assuming that the landlord's retired, and he just takes out of it the minimum living wage out of his business. However, if you've got an outside job and you earn an extra £50,000, so that'd be 54,625. Okay, just put that in there, click anywhere else on there. Okay, so your normal tax will be £10,550. Okay, after the rule changes, which came in on the 6th of April 2017, by the time this is fully implemented in the year 2020, your tax bill will go from £10,550 to approximately £31,900 based on that number of properties and portfolio. So you've got an increase of rent now per property of £1,067 required per year. This is just to stand still. There is no additional income for the landlord in this. All of this extra rent is going to go to the Inland Revenue, or HMRC. That gives you an increase of rent per household of £88.96 per month required, or an increase of rent per household of £20.53. Now once you've done this, you can click on this here and it will give you, fingers crossed, a bar chart. or bar chart, some people say. If you don't like pie charts and you'd like a bar chart, you can click on here as well if you hold your mouse over it. So after the rule changes, your tax bill's going to go to approximately 10,550. Now these figures cannot be exact because we don't know your individual circumstances, but it's an estimation. So once you've got your estimation, what you should be doing is putting in your own figures there and printing it off, or print all the pages off. Book an appointment with an accountant or your tax advisor and ask them, is this true? And if it's true, you need to make provision for it, because if you don't, you could well end up in a lot of financial trouble. And some of the lenders, such as the Mortgage Works, which is really the nationwide, are already sending warning letters out to landlords to watch out for what's coming down the pipeline. Now, whether or not the government decides to change their mind on that, we don't know, but you have to anticipate that they won't. So let's say you're in the southeast, it gets even more frightening. Okay, so say in the southeast, each property is worth £200,000. Just pick that there. And you have a portfolio of, say, I don't know, 25 properties. And your average loan to value is 60%. Okay, stress test your business. So this is anticipate what interest rates might go to, say at the end of your introductory rate or something like that, especially if you're doing houses of multiple occupancy, because the interest rates on that may go through the roof if you end up doing commercial finance and so on. So based on a 6% interest rate with an average loan to value of 60%, so it means that the value of that property, 60% of that value is actually in the form of a loan from a bank or another lender. That would mean you've got an interest bill each year of £7,200 per property, and for the 25 property that's £180,000. Now previously, before the changes, that would be classed as a business expense and you wouldn't even bat an eyelid over it. However, now this will now be classed as taxable income. Let's change the gross salary earned outside to say I don't know, say £80,000. Okay, that now changes. Before the tax rules, your tax bill would have been $20,700, and after the tax rules changes, by the year 2020 when it's fully implemented, you will have a buy-to-let tenant tax increase of 200%. Okay, bring your total tax bill to £62,200. So that's a big difference. So that's £41,500 additional tax, and all you've done is put people in houses and rented them out to them. So you've now got an increase of rent per property required of £1,660 per year. And obviously, as the value of the properties increase, so say you're in Kensington or something like that, and each property is worth, say, I don't know, £660,000. Okay, and you have a portfolio of 8 properties with an average loan to value of, say, 70%. Leave the stress test as it is. You've got to look at your worst case scenario. Okay, so your tax bill used to be £20,700, but it's going up to £72,639. That's a rent increase required from each property of £6,492 a year required from that tenant. Now, hopefully your tenant's got that sort of money, because it's £541 a month. Now, if they haven't got that sort of money, you're going to have to find that money. And if you can't find that money, you've got big problems. So, that is why you could end up tearing your hair out, like this guy has. Okay, so as I said, once you've done this calculation, or use this estimator, print it off, and if you've got a scruffy property, that's in that sort of price range, you seriously need to consider your future options. So, legal notice: the information we've supplied is for general information only. It's not intended to offer any personal, political, legal or financial advice. Should you wish to use any of the information shown for your own circumstances, you should in every instance obtain proper independent legal or financial advice from a suitably qualified individual or business, not us. Okay, and that's the end of this little instructional video. We'll see you next time.